Right now, at this very moment, there are two silver prices in the world. There's the price you see on your screen, $72. And there is the price people are actually paying. In Dubai, they are paying $99. In Japan, they are paying $130. In Kuwait, they are paying $106. In Korea, they are paying $97. Even at Walmart in America, they are paying $87. But your screen says $72. How is that possible? How can the same ounce of silver cost $72 in one place and $130 in another? The answer will change everything you think you know about silver, because what you're witnessing is not a market. It is a crime scene. The price on your screen is fake. The price in Dubai is real. And when the fake price catches up to the real price, and it will, your $72 silver becomes $130 silver overnight. That is not an 80% gain. That is an 80% gap that already exists. You are just not being told about it until now. So today, I'm going to show you exactly what is happening. I'm going to show you why Dubai pays $99 while you pay $72. I am going to show you why Japan pays $130 while COMEX says $72. I'm going to show you the paper versus physical disconnect that is breaking the market. I'm going to show you why this gap will explode. And I'm going to show you how to position yourself before the world finds out. Because the biggest wealth transfer in silver history is happening right now, and most people have no idea. Let us begin. Part 1. The two silver markets. The secret they don't want you to know. Let me explain something that will blow your mind. There are two completely different silver markets operating right now. Market number 1, the paper market. This is COMEX in New York. This is where futures contracts trade. This is where banks and hedge funds bet on silver prices. This is where the official price comes from, $72. But here is the dirty secret. Most of the silver traded on COMEX does not exist. It is paper, it is contracts, it is promises. When you buy silver on COMEX, you are not buying metal. You're buying a piece of paper that says someone owes you metal. And most of those pieces of paper never get converted to real metal. They settle in cash. The traders do not want silver. They want to gamble on the price. So they buy paper, sell paper, and never touch an ounce of real metal. This is how the price stays at $72. Because paper is infinite. You can create as much paper silver as you want. There is no limit. But real silver? Real silver is finite. Real silver has to be mined. Real silver has to be refined. Real silver has to be shipped. And real silver is running out. Market number 2, the physical market. This is Dubai. This is Shanghai. This is Tokyo. This is where real metal changes hands. This is where industrial buyers go to get silver for solar panels, electronics, and electric vehicles. This is where actual supply meets actual demand. And in this market, the price is not $72. The price is $99, $106, $130. Because in this market, you cannot fake it. You cannot settle in cash. You need real metal. And real metal is scarce. So buyers are paying premiums, massive premiums, premiums that have never existed before in the history of silver trading. And this is the secret they do not want you to know. The price on your screen is fiction. The price in Dubai is reality, and reality always wins. Part 2. The numbers don't lie. Global premium map. Now let me show you the exact numbers, because this is not speculation. This is happening right now. As of January 2026, here is what physical silver costs around the world. COMEX, New York, $72 per ounce. Dubai, UAE, $99 to $127 per ounce. Japan, $130 per ounce. Shanghai, China, $110 per ounce. Kuwait, $106 per ounce. South Korea, $97 per ounce. Walmart, USA, $87 to $90 per ounce. Let me repeat that. Even Walmart, the biggest retailer in America, is charging $87 for a 1 ounce silver bar. But the official COMEX price is $72. That is a $15 gap at Walmart, a $27 gap in Dubai, a $38 gap in Shanghai, a $58 gap in Japan, $58. That is an 80% premium over the paper price. This has never happened before. In the entire history of precious metals trading, we have never seen premiums like this. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes sees modest premiums in specific regions. But 80% systematic across entire continents? This is unprecedented. This is a market screaming that something is broken. And what is broken is the paper pricing mechanism. The paper price is lying. The physical market is telling the truth. And the truth is that silver is worth far more than $72. Part 3. Why this gap exists. The supply crisis nobody is talking about. Now let me explain why this gap exists, because it did not happen by accident. It happened because of a perfect storm of supply destruction. Factor 1, 5 years of deficits. For 5 consecutive years, the world has consumed more silver than it has produced. Every year, demand exceeds supply by 100 to 200 million ounces. Every year, the stockpiles shrink. Every year, the shortage gets worse. The Silver Institute estimates cumulative deficits of 800 million ounces since 2021. 800 million ounces. That is metal that should exist, but does not. That is metal that was consumed and never replaced. That is a hole in the market that keeps getting deeper. Factor 2, COMEX vault drain. The registered silver inventory at COMEX has dropped 70% since 2020. 70%. In 2020, there were over 300 million ounces in the vaults. Today, there are less than 100 million ounces. The metal is disappearing. Where is it going? To industrial users who need it for solar panels, to Asian buyers who are paying premiums to secure supply, to anyone who understands that paper silver is worthless and physical silver is priceless. The vault is draining. And when the vault is empty, the paper price will have to match the physical price. Because you cannot deliver paper to a solar panel factory. They need real metal. Factor 3, China's export lockdown. On January 1st, 2026, China changed everything. They reclassified silver as a strategic dual-use metal. Only 44 government-approved companies can now export silver. China refines more silver than any country on Earth. They control approximately 65% of global refined silver supply. And they just turned off the tap. This is not a temporary policy. This is a strategic move in the trade war with America. China is hoarding silver. China is restricting exports. China is watching the West scramble for metal. And every ton of silver that used to flow from China to plug Western deficits, it is now a political decision, not a market response. This is how shortages become crises. Factor 4, industrial demand explosion. Silver is not just a precious metal anymore. Silver is an industrial necessity. Solar panels need silver. Electric vehicles need silver. AI data centers need silver. 5G networks need silver. Semiconductors need silver. And there is no substitute. You cannot make a high-efficiency solar panel without silver. You cannot make an electric vehicle without silver. The industrial demand is inelastic. Companies will pay any price to get the silver they need, because without silver, their factories shut down. This is why industrial users are bypassing COMEX and going directly to physical markets. They do not care about the paper price. They care about getting metal. And they are paying $100, $120, $130 to get it, because they have no choice. Part 4. The paper market is broken. Why COMEX is lying to you. Now let me show you why the paper price is a lie. COMEX is supposed to be a marketplace for silver, but it is not. It is a casino. A casino where banks and hedge funds gamble on price movements. A casino where paper trades 24 hours a day. A casino where the price is determined by bets, not by metal. Here's how the scam works. For every ounce of physical silver in COMEX vaults, there are hundreds of ounces of paper claims. Estimates suggest a ratio of 300 to 1. 300 paper claims for every 1 ounce of real metal. In a normal market, that would be fine, because most traders settle in cash. They never want delivery, they just want to gamble and collect profits. But what happens when everyone wants delivery at the same time? What happens when industrial users say, we need real metal, not paper? What happens when Asian buyers drain the vault to pay premiums in Shanghai and Dubai? The system breaks. The paper price becomes meaningless, because you cannot deliver metal that does not exist. And right now, that is exactly what is happening. COMEX says $72. But when you try to get actual metal delivered, the price is not $72. The price is whatever the seller demands. And sellers are demanding $90, $100, and $130 because they know the metal is scarce, they know the vaults are draining, they know the paper price is fiction. The exchange for physical spread, which measures the gap between COMEX futures and actual physical prices, has exploded from 25 cents to over $1 per ounce. Backwardation has appeared. That means near-term prices are higher than future prices. That means buyers want metal now and they are willing to pay extra. That means the market knows something the screen price is not telling you. The paper market is broken. The physical market is taking over. And when the physical market wins, and it always wins, the price on your screen will not be $72. It will be $130 or higher. Part 5. Why the gap will explode, the coming price. Convergence. Now let me show you why this gap will not stay at $50 or $60. This gap will explode to zero, and when it does, the price you see on your screen will match the price in Dubai. Here is why. Reason 1. Arbitrage is failing. In a normal market, arbitrage would close this gap. If Dubai pays 99 and New York pays 72, traders would buy in New York and sell in Dubai. The gap would close within days, but that is not happening. Why? Because there is no metal to arbitrage. You cannot buy physical silver at $72, and that price only exists on paper. When you try to actually get metal delivered, You pay premiums, big premiums. The arbitrage mechanism is broken because the supply does not exist. And when arbitrage fails, prices diverge until they snap back violently. Reason 2, industrial buyers are desperate. Solar manufacturers need silver. They do not care about comics. They do not care about futures contracts. They care about getting metal to their factories, and they will pay any price to get it. Right now, tech giants and industrial conglomerates are bypassing Western exchanges entirely. They are going directly to refiners. They are going directly to miners. They are paying premiums to secure supply. This is demand that does not show up in comics trading. This is demand that the paper price does not reflect. And this demand is accelerating. Every new solar installation needs silver. Every new EV needs silver. Every new AI data center needs silver. The demand is growing exponentially. The supply is not. Reason 3, China will not reverse. Some people think China's export restrictions are temporary. They are wrong. China is not restricting silver exports because they want to negotiate. China is restricting silver exports because they need the metal. China is building more solar capacity than the rest of the world combined. China is building more EVs than the rest of the world combined. China is building more infrastructure than the rest of the world combined. They need silver for themselves. They are not going to send it to America. The export restrictions are permanent. Or at least, they will last until China has secured enough silver for its own needs, which could be years or decades. Reason 4, COMEX will break. At some point, COMEX will face a choice: deliver metal that does not exist, or declare force majeure and settle in cash. If they settle in cash, the paper price becomes meaningless. Buyers will realize that COMEX cannot deliver. They will abandon the paper market. They will go directly to physical, and physical prices will explode. This is not theory. This is what happened briefly during COVID in 2020. Silver futures traded at a massive discount to physical. The paper price collapsed while physical prices held. The dislocation lasted weeks, but this time the dislocation could be permanent because the structural shortage is real, and real shortages do not fix themselves overnight. Part 6, the math of the explosion. What happens when the gap closes? Now let me show you the math of what happens when this gap closes, because this is where you make generational wealth. Right now, COMEX says $72. Physical markets say $100 to $130. The gap is 40 to 60%. When the gap closes, and it will, COMEX has to rise to meet physical. Physical will not drop to meet COMEX, because physical is real. Physical is scarce. Physical is what the world actually needs. So let us do the math. If you buy silver today at $75 per ounce, and the gap closes to the current Dubai price of $99, that is a 32% gain, just from the gap closing, not from any new demand, not from any new shortage, just from reality catching up to fiction. But here is where it gets crazy. If the gap closes to the Japan price of $130, that is a 73% gain from current levels, just from convergence. And if Bank of America is right, and silver goes to $309, that is a 312% gain. Your $10,000 becomes $41,000. Your $50,000 becomes $200,000. Your $100,000 becomes $400,000. This is not speculation. This is arbitrage. You're buying at the fake price and selling at the real price. The only question is when the world figures out that the fake price is fake. And judging by what is happening in Dubai, Shanghai, and Tokyo, the world is already figuring it out. Part 7. How the smart money is positioning what the banks are doing. Now let me show you what the smart money is doing, because they are not sitting on the sidelines. They are loading up. JP Morgan, the biggest bank in America, just did something historic. They flipped from net short to net long on silver. For years, JP Morgan was the biggest short seller in the silver market. They held massive positions betting against silver. But now they are buyers. Aggressive buyers. Reports indicate JP Morgan is standing for maximum physical delivery on COMEX contracts. They are not settling in cash. They are demanding metal, real metal. Why would the biggest bank in America suddenly want physical silver? Because they see what is coming. They see the gap between paper and physical. They see the vault drain. They see the China export restrictions. They see the industrial demand explosion. And they want to be on the right side of history. Meanwhile, Citigroup is reportedly short 3.4 billion ounces of silver. Bank of America is reportedly short 1 billion ounces. That is more than 4 years of global production. If silver goes to $130, where Japan is already paying, these banks face catastrophic losses. We are talking tens of billions of dollars, maybe hundreds of billions. This is why you are seeing emergency margin hikes. This is why you're seeing volatility. This is why the paper market is desperately trying to hold the price down. Because if the price rises to match physical reality, some very big players lose everything. But they cannot hold it down forever. The physical market is too strong, the demand is too real, the shortage is too severe. And when the dam breaks, silver will not go up 10%. Silver will go up 100%, 200%, 300%. Because that is where the physical market already is. Part 8, how to position yourself. Action steps. Now let me tell you exactly what you should do. This is not financial advice, but this is what the data is screaming. Step 1, understand what you're buying. When you buy physical silver, coins, bars, rounds, you are buying at the real price. When you buy paper silver, ETFs, futures, you are buying at the fake price. Paper silver has counterparty risk. If the system breaks, your paper could be worthless. Physical silver has no counterparty risk. If you hold it, you own it. In a market where paper and physical are diverging, physical is the safer bet. Step 2, accept the premium. If you go to a dealer today and they charge you $85 for silver that COMEX says is $72, do not complain, pay it. Because $85 is still cheaper than $99 in Dubai. $85 is still cheaper than $130 in Japan. The premium is telling you something. The premium is telling you that silver is worth more than the screen says. The premium is telling you to buy now before the gap closes. Step 3, diversify your holdings. Physical silver for long-term wealth preservation. Silver mining stocks for leverage to higher prices. Some paper silver if you want liquidity. But weight your portfolio toward physical, because physical is where the real value is. Step 4, ignore the paper. Price crashes. The paper market will crash sometimes. CME will hike margins. Leveraged traders will get liquidated. The price on your screen will drop. Do not panic. That is the fake price dropping. The real price, the physical price, will hold. Use paper price crashes to accumulate more physical at a discount. Step 5, have patience. The gap will not close tomorrow. It could take weeks. It could take months. But it will close, because it always closes. The fake price always converges to the real price. And when it does, you want to own silver, lots of it. So here's where we are. Dubai pays $99 for silver. Japan pays $130. Your screen says $72. This gap is the biggest in precious metals history. And it is telling you something. It is telling you that the paper market is broken. It is telling you that physical silver is scarce. It is telling you that the price on your screen is a lie. COMEX inventories are down 70%. China has locked silver exports. Industrial demand is exploding. 5 consecutive years of deficits. JP Morgan flipping from short to long. Every single indicator is screaming the same thing. Silver is worth far more than $72. The physical market knows it, Dubai knows it, Japan knows it, Shanghai knows it. The only people who do not know it are the ones staring at the fake price on their screens. Do not be one of those people. The gap between paper and physical is not a mystery. It is an opportunity to buy at the fake price before the world wakes up to the real price. An opportunity to position yourself before the convergence, an opportunity to create generational wealth. Because when Dubai and New York trade at the same price, when the gap closes from $50 to zero, when the paper market is forced to match physical reality, silver will not be $72. Silver will be $100, $130, $300. And the people who bought at 72 will be very, very rich. The question is, will you be one of them? Or will you watch from the sidelines, telling yourself you knew about the gap but just didn't act? The information is in front of you. The opportunity is in front of you. The gap is screaming at you. What you do next is up to you. But do not say you were not warned. Because when silver hits $130 and everyone asks, how did this happen? This video will still be here. And you will either be grateful you listened or regretful you did not. Comment below, did you know about the Dubai gap before this video? Share this with anyone who owns silver or should own silver. They need to see what the screen is not telling them. And remember, this is educational analysis, not financial advice. The choice is yours. But the gap is real, and the gap will close. The only question is whether you will profit from it.